because having 0 instead of minus 49 would have been very good. So over time, these investments can pay off. The gains are locked in. You can never experience a loss in cash value from year to year. Once the gains have been declared, once the dividend has been declared, you got it. It can't go away. So that means that in terms of an overall investment portfolio, it looks like it fits into the side of a very conservative part of the portfolio. It's not going to compete with good investments in other areas. Now, there's hundreds of mutual companies. There's thousands of stock, well, not thousands. So there's like, I don't know, 1,400 stock companies in the country. Most of them are very local. They're small. I would never touch them if I were you, unless you have cancer and they're going to approve you. Somebody else won't. But there are good ones. Now, in the stock company world, it doesn't matter that much, because you should never buy permanent insurance from a stock company, because they don't give you dividends. You'll never have a cash value worth anything. So you should always buy permanent insurance from a mutual company, of which there are hundreds, so you've got a big choice. But of those hundreds, there are only 5 that are really outstanding. And those 5 across the past, I don't know, ballpark 100 years, have an excellent claims paying history, an excellent dividend history, outstanding cash value growth, and all of them, not by chance, are very deeply committed to customer service, to creating long-term relationships for investment with people, which is very different from many other insurance companies, which look at the insurance sale as a one-time thing, and then they hope you don't die before you drop the policy. Which, by the way, is a business plan for some insurance companies. The average life of a term insurance policy is 7 years, historically, hundreds and hundreds of companies. Why? People drop it after a while. Well, you know, the mortgage is paid down, so I don't have to worry about it so much. Or, the 401k is pretty big now, life will be okay if I don't, you know, don't waste money on this. Or, more likely, they switch companies, because there's a lot of competition. There are tens, thousands, hundreds of thousands of insurance brokers out there. So they find a company that's cheaper, they replace your policy with a cheaper company. The company which sold you the policy in the first place, once it's had its policy in place for a couple of years, 2 or 3, not only have they made back all of their costs of creating the policy, they've also made enough profit that if you drop it, they don't care. They've made their money. In fact, they're better off if you drop it so that you don't die at their expense. So, you know, that's not a relationship that I think of as a good client-professional relationship. Therefore, if you want to buy cheap term insurance, that's fabulous, happy to sell it to you, and we can use any company around, whatever's best. However, if you want permanent insurance, then you really have to be careful. Because in the total world, the last time I checked 1,600 and change insurance companies, there's only 5 that really have financially, economically, investment-wise, powerful insurance policies. Okay, now what are their characteristics? Number 1, all 5 have the same characteristics, by the way. They all share this. Number 1, they have high underwriting standards. That means that they have low mortality experience. They refuse to insure sick people. They refuse to insure people who are likely to die earlier rather than later. And as a result, fewer people die on their watch, and they don't pay as much death benefit. Low mortality experience means low benefit payout. They don't pay much death benefit because people don't die. High loss ratio, very important concept, very people understand it. Loss ratio is the amount of money that the insurance company takes from your premium dollars as profit to itself, and how much they give back or put back, either in the form of dividends or cash value increase or death benefit payments. So a high loss ratio means more money to the policyholder with bigger dividends and a higher cash value. A high loss ratio might be like 85%. So 85 cents out of every premium dollar goes back to the policyholder one way or another. Now, rigorous fiscal controls. There are 3 things that cost insurance companies money. Number 1, death benefits. Number 2, the cost of running the policy, setting it up, paying the broker his or her commission, and then just maintaining things as they go along. So that's like clerical mostly. And number 3 is the success or lack of it in their investments. So insurance companies traditionally have to be very conservative to make sure the money is there when they need it. However, over the past 100 years, all too many insurance companies have become very speculative in their investments and have lost money. Bad news. Some went out of business because of that, creating a lot of havoc and unpleasantness. So rigorous financial controls, good investment success, low benefit payout, and low running expenses mean that an insurance company, one of these five, has lots of money to give back to the insured, to the policy. Also, small, full-time professional sales force. People don't generally think about that, but the article at the end of this little handout, you should read. There you'll discover the opposite. An insurance company which specializes in a very large, relatively untrained, unprofessional, part-time sales force, and they have lots of problems. You can read, we don't have to spend time now, you can read about it. And I want to thank Carla for sending the article to me. It was very nice that you pointed that out. Okay, so some of this stuff is obvious, but people don't think about it, nor do they have whatever it takes in the way of intestinal fortitude to actually challenge their insurance broker. How long have you been in the business? What is your background and training? How do I know that you know what you're doing? Oh, and by the way, what is your commission on this? How many of you would like to ask your broker that question? 1, 2, all right, good for you. 3, yes, okay. Most people give me this deer in the headlights look when I mention that. Okay, very important question. Ask your broker, yes. Oh, I thought you were raising your hand for a question. All right, fine, we're almost finished. Okay, very important question. One of the reasons it's important is because many brokers will not answer it. Because they know that you won't be happy with the answer because commissions are big in the insurance world. I'm happy to say. But it's an important question because it ascertains 2 things. Number 1, is your broker honest? Is he willing to, or is she willing to talk with you about these things? And number 2, if the commission is really outsized on a specific product, maybe you don't want that product. Maybe you need a different company or a different broker. So these are things that are important. Well-trained. Do they have the degrees, the CLU, the CHFC? Are they well-educated in general? One of the things you'll notice in the article at the end of this is that many insurance companies demand that their incoming potential, sales trainee, future insurance professional already has a BA or an MA and is not just off the street. Others do not. Closely supervised. I cannot tell you how aggravating it is to be closely supervised. Well, no, I could, but it's not for now. Close supervision over sales force is extremely important in an industry where there is so much graft, so much incompetence, and so much dishonesty. So a closely supervised sales force is very important. That supervision also requires that best practices be maintained. In other words, there are some companies, I won't mention names in this context, but if you have a concern and you ask me outside, I will talk to you about companies, one-on-one. Some companies simply say, go out and sell, we'll worry about anything else later. Other companies say, if you screw up, we fire you. Done. You cannot be on our sales force unless you maintain best practices. It's good to know the difference. And then finally, service-oriented. If the average life of a policy is 7 years, what's the sense in continuing a relationship with the person who will be gone in the next 6.5 years? As opposed to, we want clients for life. We want people to be around for a long time and to continue to work with us and give us referrals and do future business. It's a very different business model. So I like the second one. Okay, so now that you know all this stuff, you can go out and do it on your own, right? There you go. So, go buy online. And this is a wonderful thing. Buying online is great. It's helped my business immensely. Not that I sell online, but rather people ask me, gee, how can I get it cheaper online? So I say, go and do. And then when you got it, come and call me and we'll sit down and we'll go over it. So far, I haven't lost more than 1 or 2 cases in that context. Okay. Why hassle with all of the above? You can do that or you can call me because I already know this stuff. So I can sit down with you and say, hey, that company is one that you can use here. Here's their dividend history. They don't give dividends. Here's all that stuff. That's all at my fingertips. Better use of your time to work with me. Greater likelihood of success, I think. Yeah, avoid mistakes. And to quote Clara, you now know what you don't know about life insurance. Well, I know what you don't know. So you can either learn it on yourself, on your own, or work with me. So I suggest. All right. 2 minutes for questions?
How many years have you been doing this?
19.
So he really knows, 19 years.
Ta-da.
So what if this doesn't work out?
What if it doesn't work out? I retire. This is also comprehensive. Nobody has a question? All right.